My name is Rhiley Langworthy, and this presentation will look at the effect of artificial intelligence in accounting. The American accounting system really began after the establishment of the American Association of Public Accountants in 1887. In 1896, New York State officially recognized the qualification known as Certified Public Accountant. However, at this time, accountants were more utilized as consultants for finances and businesses. In 1913, the 16th Amendment was made to the U.S. Constitution, which completely changed the way of taxation in the U.S. and created the accounting system we use today. That system has been in effect for over a century now and probably will not change anytime soon, but what I can see changing in the future is an increased use of artificial intelligence, or AI, in finances and accounting. The first income tax form, the 1040, was created in 1914 by the Bureau of Internal Revenue, predecessor to the modern-day IRS, and was only 3 pages long. In 1915, people were still voicing concerns about the complexity of the income tax, so Congress passed the Revenue Act of 1916 to adjust the tax rates and income scales, which attempted to categorize the population. As you can imagine, not all people fit neatly into categorized boxes. These early tax rates have gone through many revisions to account for the complexity of individuals. Since this point in time, the tax code has become more and more complex. The biggest reason for our current tax complexity is that simplistic taxes almost always conflict with policy goals. However, this complexity can lead to individuals not utilizing areas of the tax code that could be beneficial for them. Most people would agree that taxation should be fair, conducive to economic prosperity, enforceable, and simple. The issue starts when getting people to agree on the degree of importance to each area. The advantage to the introduction of AI in finances and accounting is that computer processes can simplify these complex tax codes for people to better utilize all areas of the tax code to their benefit. This promotes the overall economic desire for increased AI in other areas of accounting and finances. Economics typically revolves around supply and demand concepts as well as cost-benefit analytics. Many economic events undergo multiple stages of a cost-benefit analysis, starting with a high cost and low benefit and ending with a low cost and high benefit. Think about the telephone system, first automobiles, and the internet. These things all started as being luxury items only the wealthy could afford. And who would really need them anyways? People already had other ways of accomplishing the tasks at hand. They would write letters to distant friends, use horses and bikes for transportation, and the internet was just impractical to have without a real use for it. I predict similar progression with AI and believe it is more welcomed in the accounting field than in some others. Many tasks in accounting are repetitive, and this is when automation can save time, increase accuracy, and unfortunately eliminate people from positions. In accounting, automation will rely on artificial intelligence and computers to perform these tasks. Artificial intelligence processes take 2 forms currently. Let us call them traditional and deep machine learning. Traditional machine learning utilizes functions designed to meet a set of rules. These processes work well when there is limited variation in the data. Deep machine learning works more like a human brain. A data set is created containing data points for a given situation. A training process is run to create standards. A final process compares newly input data to the data set and outputs a percentage-based comparison. This comparison is then used to determine a conclusion. An example of this is facial recognition. Many photos are stored. The training process measures various parameters about a human face. When a new image is input, the process compares the new image measurements to the existing data set and outputs a percentage estimate of who is in the image. Artificial intelligence can generally be defined as the ability of a machine to assess a situation and make an informed decision in pursuit of some aim or objective. This simply means that through machine learning, computers use mathematical procedures to quickly analyze and interpret data in order to make predictions and changes accordingly, as well as identify patterns in the data. In the past, both supply and demand for AI in people's lives was very low. As technology has progressed and become more widely available and less expensive, people want more of it. Further on the demand side for AI in accounting is that there has not been much productivity growth in advanced economies in recent years, and some tasks are becoming too complex for humans to do in a timely fashion. They require a level of processing power that only a computer could provide. These higher levels of processing power, along with software and hardware required, were not previously available. However, the recent upsurge in supply is starting to meet the demand. Today, there are multiple forms of AI that are used to improve businesses and individuals' lives. In accounting, we see this with chatbots, credit scoring, auditing using digital documentation, tracking and procuring data, and expense management, including the review of expenses and fraud detection. A recent survey reported that 75% of the respondents believe that by 2025, the economy will reach a tipping point at 30% of corporate audits being performed by AI. The good news for now is that AI cannot interpret data subjectively in the way that humans can. If you have a smartphone, you've probably realized this already. It's pretty dumb with common sense items. It has also been realized that an AI system does not understand that correlation is not always causation. With credit scoring, for example, when looking for factors that increase one's likeliness to default on their loans, the AI might tell you that individuals with brown eyes are more likely to default on their loans than individuals with blue eyes, or something ridiculous in that manner. AI have also turned out to be quite bigoted at times, so the trust is not all there yet and going fully autonomous. However, AI is useful for the repetitive processes involved in lower-level accounting. One company, Ernst & Young, has already estimated that their number of new hires to be cut in half each year as a result of AI performing the repetitive administrative roles that recent graduates would usually fill. This decrease in employment opportunity for recent graduates will create weaker job outlook, causing less people to view accounting as a career choice, but increasing the value of accountants at the same time. Still, there would be a need for someone to analyze the process and draw a meaningful conclusion from the data. I believe that we can at least expect the teaching of accounting to change, for it to be more focused on the interpretation of data and less on the calculations involved. It seems a shift back is coming for accountants, and their roles will revert to counseling and advising once again, but with more processing power and data than was ever available before. However, I do not think their demand will falter. Accountants will still be necessary for businesses, just not as necessary for most individuals. I think it will increase their value because only businesses that have large amounts of data to interpret will need their counseling. Accountants will be utilized as critical thinkers for analyzing financial accounts in order to find ways to better increase profitability for a business. The supply of new accountants into the industry would be low. The demand would remain relatively the same, meaning less competition and more value. This change will not happen overnight. I believe the small area like the one I am from will not have access to the necessary AI applications for quite some time yet.